Before we begin, make sure to tap the like button and subscribe to the channel and hit the bell so you don't miss future content that helps you master your financial future. Today we're breaking down one of the most misunderstood systems in modern society, the banking system. How it really works, where your money actually goes, and why understanding it can completely change the way you think about the economy. Most people believe a bank is just a safe place to keep money. You deposit your paycheck, maybe open a savings account, and withdraw cash when you need it. But in reality, banks play a much deeper role. They're the beating heart of our financial system, serving as intermediaries between people who have money and people who need it. This includes individuals, corporations, and even governments. When you deposit money into your account, it doesn't just sit there. The bank uses most of that money to lend to other customers. That's how they generate profits, by charging more interest on loans than they pay out on deposits. It's a business, and you're part of it whether you realize it or not. But here's where it gets more complex. Most modern banks operate under what's called the fractional reserve system. That means they are only required to keep a small percentage of your deposit on hand, usually around 10% or less. The rest is loaned out. So if you deposit $1,000, the bank might only keep $100 in reserve and lend out the remaining $900. That $900 can then be deposited in another bank and relent again, creating a chain of new loans and deposits. This process multiplies money across the economy. It's called the money multiplier effect. And it means there's actually far more money circulating digitally than there is physical cash in existence. Here's something even more surprising. Banks don't just move money around. They literally create it. When a bank gives you a loan, they don't pull existing cash from someone else's account. Instead, they generate new digital money and credit it to your account. That money didn't exist before the loan was approved. It's called credit creation, and it's how most money in the modern economy is born. So who oversees all of this? That's the job of central banks. These include the Federal Reserve in the United States, the Bank of Canada, and the European Central Bank. Central banks don't work with the public directly. Their job is to manage the money supply, set interest rates, and ensure economic stability. When central banks raise interest rates, borrowing becomes more expensive. People and businesses tend to borrow less and spend less, which can slow inflation. When they lower interest rates, borrowing becomes cheaper and the economy usually speeds up. This balancing act affects everything: home loans, credit cards, investment decisions, and even job growth. In times of economic crisis, central banks also use a tool called quantitative easing. This involves buying large amounts of government bonds and injecting cash into the banking system. The goal is to stimulate borrowing, investment, and spending to prevent a deeper recession. Governments also regulate banks heavily to prevent collapse and protect depositors. Banks are required to hold capital reserves, go through financial stress tests, and follow strict lending standards. In many countries, your deposits are insured up to a certain amount, so if your bank fails, you don't lose your money. But despite all these protections, the system still relies heavily on trust. Trust that your bank won't go under. Trust that the government will step in if it does. And trust that the digital numbers in your account actually represent real value. Debt is another crucial part of this puzzle. In modern economies, debt isn't just common, it's necessary. People borrow to buy homes, cars, and education. Businesses borrow to expand. Governments borrow to fund programs and infrastructure. This borrowing powers economic growth. But too much debt can be dangerous. When loans go unpaid, or when the debt becomes too large, it can lead to financial collapse, just like we saw in the 2008 global financial crisis. Interest rates are at the center of all of this. They determine how expensive it is to borrow and how rewarding it is to save. High interest rates cool down the economy and fight inflation. Low interest rates encourage borrowing and spending. But they can also inflate bubbles and weaken the value of money over time. Today, banking is also evolving faster than ever. Most people no longer go into a bank. They transfer money online, invest from their phone, and apply for loans in minutes. Fintech companies are disrupting traditional banks, offering faster, simpler, and often cheaper services. Meanwhile, central banks around the world are exploring something new: central bank digital currencies, or CBDCs. These are digital forms of national currencies that could change the way we store, move, and use money. They could offer faster payments and more security, but they also raise serious questions about privacy and control. Of course, no system is perfect. Many critics argue that allowing private banks to create most of our money gives them far too much power. Others point out that the system benefits wealthy investors more than average workers. And when big banks fail, it's often taxpayers who foot the bill. That's why some are calling for reform. Ideas like public banking, stricter financial regulation, and even decentralized systems like cryptocurrency are gaining more attention as people question the fairness and stability of the current financial model. So what does all of this mean for you? It means that understanding how the banking system works isn't just for economists or bankers. It affects your savings, your debt, your ability to buy a home or start a business. It affects job creation, inflation, and your ability to build wealth. The more you understand it, the more control you have over your financial future. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share it with someone who wants to better understand the world of money and how it really works. This video is for educational purposes only. It does not constitute financial, legal, or investment advice. Always do your own research or consult with a licensed financial advisor before making financial decisions.